So today I'll help you to resolve the problem set I sent you the last time. So our objective is to estimate the free cash flow, right? Leverage and unleveraged free cash flow and leverage free cash flow. Okay, and then we have to answer the question if the project is accepted or not, right? And this is the problem we are facing. So we are in a company, and the company is trying to answer the question of if the project is accepted or not. And the information about the project is the fixed asset will be imported, okay, with the price of 100. And this is the additional information I give you now. The economic life of the project is 5 years. The imported tax is 10%. The transportation cost is 10%. Value added tax, indirect method of 10%. And installation cost is 10%. The cost of testing is 15%. The revenue from testing is 30%. And the tax rate is 20%. And regarding working capital, the short-term assets invested in the project is 20, and the short-term liabilities are 5. Okay, and we know that 80% of fixed assets total cost will come from bank loan that will be paid annual by. Okay, this is with okay. With or by, okay, annuity in 5 years, with a rate of 6% per year, with the interest rate of 6% per year. Expected revenue is 80 in the first year, then not income increase, then increase, okay, increase 20% each year from the next years for the next years, okay, and then this should be cost, okay, cost. The cost excluded depreciation, interest and tax is 30% of total revenue. 20% of revenue in each year from year 1 to year 4 will be received in the next year. So we'll have 5 years of the project, right? From year 0 to year 5. Okay. So now we'll try to resolve the problem. So the first thing let's have a look at our objective. So our objective is to calculate the blue line in here, right? FCF and FCFE, and then calculate IRR with FCF and FCFE, and then we will make the conclusion if the project is accepted or not, right? To do so, the first thing we have to do is to estimate the total cost of fixed asset, right? So to estimate those costs, we should use the information provided in here. Then we calculate it. So the first thing we should make sure that we understand about the cost of total asset of cost of total cost, not cost, total cost of fixed asset gonna be cash out, okay, cash out for kind of building or buying fixed asset. minus cash in, any cash in from building up or buying the asset. Okay, so because of that, what we have to do is firstly to calculate any cash out for building or buying fixed asset. Okay, and then we have to calculate any cash in from building or buying the fixed asset. And as you may know that the cash in from buying or building fixed asset is from kind of testing the asset. Okay, so things like you buy or you build a machinery, you buy a machinery before you can use it for many years. You should test it. Okay, you should test it before you use it. However, when you test it, it's help you to make some revenue. Okay, it's help you to make some revenue, and it's also how can I say, you also incur some kind of cost to make those revenue from testing. So which means that you have to calculate cash in and cash out from the testing, from the action of testing the asset. Okay, so in here the first thing we have to calculate is the cash in from testing the fixed asset. So as you see in here, revenue from testing is 30, so cash in is just that. So that, and cash out, so we have two items of cash out from testing the fixed asset. The first thing is the cost of testing, which is in here. I gave you 15, right? And then the tax from testing. So how can we calculate tax from testing? So you can see that tax from testing is equal the income before tax multiply with what? With tax rate. The tax rate in here is 20%, and the income before tax is revenue minus what? Minus cost, right? So we have it in here now. So the total cash out in here could be 15 plus 3, right? Then we will come up with net profit from testing fixed asset. What is the profit? Profit is what we received. Net profit is net of anything we get in terms of cash from testing the fixed asset. Okay, so this one could be cash in minus cash out. Okay, so now we come up with the idea of total cost of fixed assets. So the total cost of fixed asset is any cash out for buying fixed asset minus any cash in from buying fixed asset. So cash out, so it's equal, cash out is imported tax, okay, and then plus imported tax. So imported tax could be this one multiply with 10%, okay, plus in transportation cost in here, and we do not add up VAT tax in here because it is indirect method, which means that this item gonna be deductible with the output VAT tax. Okay, I explained to you on class very clearly. Okay, then we add up installation cost, right? That is all the cash out for buying the new fixed asset. Then come to the net profit from testing fixed asset we just calculated. Okay, this is the total cost of fixed asset, and this gonna be depreciated throughout 5 years life, 5-year life of the fixed asset. Okay, 180, right? Okay. Regarding working capital invested in the project, it could be short-term asset minus what? Short-term liability. Okay. Okay, cool. Now we come to the loan payment schedule. You learn this when you learn about time value of money. This is application of time value of money. You should know how to make loan payment schedule. Okay, in the loan payment schedule, you should have principal payment, you should have interest payment, you should have total payment, and you should have debt. Okay, remain debt. So this is the year. So in the year 0, which is the time the point in time that you get the debt, so it's equal as we said in here, 80% of fixed asset total cost will come from bank loan. So it could be 80% multiplied with the total cost of fixed asset is here, right? Okay. So that's the debt, initial debt or loan. Okay, the amount of debt, and this gonna be paid in 5 years by annuity. What is annuity? Annuity is equally payment throughout the year. Okay, so which means that every year you pay the same amount to pay back the debt. Okay, and in the payment you have not only debt but also interest. So it means that if you add up principal payment with the interest payment, you got the same amount with among each year in here, right? So I will make it kind of orange color in here. Okay, so every amount in here, amount of payment in here is the same. So they are the same throughout 5 years period. Okay. So how can you calculate it? So as you learn in time value of money, it could be PMT function in here, right? Okay. So and rate in here is 6% per year. 6%. You just put 6% in it, and then N per is the amount of the same payment. So in here we have 5 years, so we have 5 payments, 5 same payments amount. Okay, so it's 5, and then the PV is the amount of money you get now. Okay, that's the amount of loan. Okay, the value of the bank loan, which is 94.4. But to get the positive signal or positive value of total payment, you should give the negative signal for PV, which is negative C33, like this. And you should fix it by press F and F4 on your keyboard, okay, to fix that address, so that you can copy the formula to the next cell on the Excel sheet. Okay, enter. And now you can just don't care about the unit of currency in here. So in here it's default in yen, Japanese yen, but actually it could be in Japanese, in US dollars or whatever. Just don't care about it. Or I might change it to US dollars. Okay. So, which means that every year we'll pay the same amount of $22.41 or billion dollars, whatever. Okay. Let's say $1 billion. Okay. Then now we have to calculate the interest. The next item is interest. It's gonna be the debt remained debt multiplied with interest. What is the interest rate? Interest rate is 6%, right? 6%. And how about the next interest? Okay, before we calculate the next interest, we calculate the principal payment in the first year. It's going to be total payment minus interest payment. Okay, and then we have to calculate the debt remaining after we make the first principal payment. So it could be the debt before we make the first principal payment minus the first principal payments, right? This one. Okay, so until now you got every information for the first payment schedule for the first year. Okay, then we apply the same formula throughout the loan payment schedule. Okay, copy it, you copy it, and then here you copy it until the end. So you can see in here, at the end of the 5-year period, your debt gonna be 0 because you pay it out. Okay, good. Okay, so 2 up to the decimal. Okay, cool. Okay, now we'll come to the free cash flow estimation sheet. Okay, so first thing is revenue. So revenue in the first year could be 80, right? 80. Cool. And the next year gonna be increase 20%. So which means that it's gonna be equal the last year, previous year multiplied with 1.2, right? Okay, and this year's gonna be the same, so we can copy this one throughout the years left. Okay, cool. Okay, cool. And the cost, as you can see in here, the cost excluded depreciation, interest, and tax gonna be 30% of total revenue. So in here you just say 30% of multiply with total revenue, which is here. Okay, and this formula is applied the same throughout every year. Okay, so we got the costs. Included depreciation, interest, and tax. Then we go to EBIT. So EBIT is gonna be revenue minus minus costs that not include depreciation, interest, and tax. And then it's also minus depreciation in here. Let's put like this. Okay, and then you can copy the formula throughout year. But now we have to calculate the depreciation cost. So suppose that depreciation cost gonna be estimated by using prime method or straight line method, which means that we divide the total cost of asset over the number of years of the asset, which is 5, right? Which is over 5. Okay, make it over 5. Okay, before we do that, we just fix this cell by press Fn F4. Okay, to kind of fix that address. Then we divide it by 5. Okay, cool. Okay, so now we'll see we have the information of EBIT very clearly on that. Now we go to the next item of delta working capital. Delta working capital could be for the year 0. It is here. We have already in here, right? For the next year, so for the delta working capital, we need to have information on. We need to have information on kind of short-term asset or current asset, the increase of current asset. Okay, current asset. And then we should have kind of current liabilities. Okay. So every year from year one, we have okay, the increase of current asset is how much? You can see in here 20% of revenue in each year from year 1 to year 4 will be received in the next year. So which means that in year 1 we'll have 20% of revenue. 20% of revenue gonna be receivable. Okay, receivable. So it's equal 20% multiplied with revenue, which is receivable, and receivable is current asset. Okay, that's increase. And current liabilities could be 0 because we don't have any information on that. Next we'll have the same 20% of revenue in here. Oh, sorry. So this one is 20% of revenue, but then we get back 16 from the previous year, because in the next year we collect the account receivable of the previous year in here. Okay, the same with this one. So this one gonna be 20%. Okay, 20% multiplied with revenue in here minus what we have in terms of account receivable from revenue in here. So minus 20% of this one. Okay, that's it. And the next year gonna be the year 4th gonna be 20% again of this one minus 20% of the previous year, this one. Okay, and the last one we don't have. Okay, in the last one what we have in here. So in last year we don't have any kind of receivable because we don't see any information that saying that in the last year we have 20% of revenue in receivable, because it said that it's just from year 1 to year 4 only. Okay, so current liabilities in here 0, 0, 0, and then you can see that so you can see in here that the delta working capital in year 5. In year 5. Okay, in year 5. Okay, could be what? Could be, so you put 15 in delta working capital in year 0, and this one should be receipt at year 5. Okay, at year 5. So this could be minus this one, and minus what? Minus what is remained in year 4. So year 4, at the end of year 4, you have 4.608 current asset in here in terms of receivable. And when will you receive it? So you'll get it back in year 5. So you minus this one also. Okay. Okay, cool. So current asset gonna be current delta working capital gonna be this one minus this, right? And this is apply the same with this. Okay. Okay, cool. Okay, so that's delta working capital. So that's good. Okay, so let me re-put information in here. Okay, so working capital at the end of the project gonna be this minus of, okay, minus of sum of this, sorry. So in here you don't get back, in here you get it back. And okay, this one, and okay, this one plus this only. Okay, because you see that if you put 15 in here and you put 16 in here as well, and you put 3.2 in here and 3.84 and etc. So you have to make the sum up of this one, which means that you will get it back all the thing you put in working capital. But actually for the from the first year to the next, you put something in, but the next year you get it back, and then you put something in and you get it back. So you do not need to sum it up. Okay, cool. What is the delta capex? So the delta capex, so in here we don't have any kind of information for liquidation of fixed asset at the end of the project. So let's say it's 0. Okay, throughout the year, 1, 2, 3, 4, 5, 0. But actually in the first year, delta working capital could be this amount, because it is the amount of money put in a fixed asset, or that is the amount of money needed to buy a fixed asset. Okay, now we come up with the the information of FCF. So FCF gonna be EBIT. EBIT is this one, right? EBIT, this one, multiply with 1 minus 20%. Okay, and then we plus D. Where's D? D is in here, right? Okay, and then we subtract delta working capital, which is here. Okay, and then we subtract also the delta capex. Okay, we have formula, and I taught you this formula very clearly already. Okay, and enter. So we have this one, and we copy that kind of formula throughout the life of the project. So we have, this is the FCF of the project, and then we come up with the FCFE, which is leveraged free cash flow. So we should care about borrowing. Okay, add additional borrowing in the first year. It is this one equal what? Equal 94.4 in here. Okay, 80% of total cost of fixed asset. Additional borrowing for the next year, no, and no. Okay, but actually debt payment for the first year, 0. For the year 0, it's 0. For the first year, you see that the payment for the first year is here, right? So this one should be this. Okay, and this one should be this, the same. So we copy like this. See? So 21st in here, 21st in here, 21, sorry. Then we come up with the idea of net borrowing, which is borrowing minus debt payment. Okay, and we copy that information throughout the year. So we do not have positive borrowing. Then we have FCFE, which is FCF subtracting interest, after tax interest payment, and plus net borrowing. So it's equal FCF in here. Okay, minus interest. Where's interest? So we done interest in here. Okay, in here, multiply with 1 minus 20%, then plus net borrowing. Net borrowing is here, right? Okay, cool. And we copy this formula throughout the year. Okay, cool. So now we come up with the idea of IRR. So we see that why we come up with the idea of IRR. We come up with the IRR because we want to answer the question of if the project is accepted or not. Okay, to answer that kind of question, we should calculate IRR. So equal IRR. You learn about this already. So we just use information from here until the last one. Okay, so IRR is 34.39% per year, and with FCFE with FCFE in here we put IRR of what? Of value of here, from here until the end of the project life. So we can see that IRR for the FCFE it's 73.88% per year, which is okay, let me see. Okay, which is much better than 50% per year. So the conclusion in here is that I will use the if function in here. If this one bigger than 15%, then the project is accepted, right? And if it's not, the project is rejected. Okay, so what do you reckon? What do you guess? Is it accepted in this case? Of course it is accepted, because the IRR is much better than, much larger than expected rate of return, which is 15%. Okay, so that's the answer for this. So for the first one, it's in here, the blue line in here. Okay, for the second question, calculate IRR of the project, it is here and it is here. And for the last question, given the answer needed, and notice answer, or owner, the owner, okay, owner of the project needs expected return of 50% per year. Will the project be accepted? So the answer is in here. The project is accepted. Okay, accepted. Okay,